welcome to you all wherever you are around the world. Welcome to you, Phil Gerson, Deputy Director of the IMF's European Department in Washington. So this hour-long discussion is going to be all totally on the record. Phil and I will be speaking for about half an hour amongst ourselves. We'll be bringing in the guests from around the world as well when we can to ask questions. This is going to be recorded as a podcast, but it will all anyway be totally open to you all. So looking forward to a good discussion. Phil, this talk is about the report that you brought out around about 6 weeks ago, just before Christmas, the IMF's report on the euro area, which is part of the regular consultative mechanisms. You make a number of recommendations and points about the pandemic. As always, the IMF wants a bit more expansion, monetary and fiscal in variety. Could you talk us through the main points of your report, please? So over to you, Phil.
Sure. Thank you very much, David, and thank you to OMFIF for the opportunity to be here today. The report itself is available on the IMF website. So rather than go through a comprehensive review of what's in the document, I'll just highlight some things. And I want to start with a statement that I think is obvious, but that bears emphasis because it's going to color everything that I have to say today. We're operating under extraordinary uncertainty, and I think that's something that needs to be kept firmly in mind when you evaluate anything that I say. I think really anything that anyone has to say about short and medium. The primary source of that uncertainty is the virus. As in much of the world, the euro area has been hit extremely hard by the pandemic with devastating human and economic costs. The development of the vaccine obviously gives suggestion that there may finally be light at the end of the tunnel, but the rollout of the vaccine has proven more difficult than many people may have expected, even in advanced economies. It would be usually ironic and a tragedy if this great intellectual event, the development of not just one, but multiple effective vaccines, were stymied by something as prosaic as issues related to the production, distribution of the vaccine. But for as long as the virus continues to spread and to mutate, discussions about the future are going to be subject to a huge amount of uncertainty. So with that as background, with that obvious statement as background, let me make a second obvious statement, that unprecedented policy responses at the EU level, at the euro area level, and at the national level have been crucial in helping to cushion the impact on Europe of the pandemic. In particular, lifelines to households and firms have helped protect jobs and livelihoods, supported by both central fiscal funds and monetary policy actions, and helped stabilize employment despite the steep drop in output. Let me cover a little bit of the background of what's happened since the report came out as well. After a very sharp decline in output in the second quarter that reflects the impact of the shutdowns in response to the pandemic, output in the euro area bounced back very strongly in the third quarter, much more strongly, in fact, than we had expected. But new lockdowns late in 2020 in response to further waves of the pandemic have led to weaker economic activity in the fourth quarter and therefore weaker growth momentum going into the new year. While the flash estimates for euro area quarter four GDP were better than many people had feared they might be, it's nonetheless the case that the euro area entered 2021 in a difficult position. And the more difficult start to the year is reflected, for example, in weaker PMIs, especially in services, and in reduced retail mobility in January. The expectation that renewed lockdowns would depress output in the fourth quarter and would carry over into early this year is reflected in the January update to the IMF's World Economic Outlook, which came out, as the name suggests, came out last month. And I should note that came out before the quarter four flash data were available. We expect real GDP to grow by about 4.25% in the euro area this year. But that January forecast is a full percentage point lower than what we had expected in October when the previous WEO was published, which reflects the impact of these renewed lockdowns. It's also a full percentage point lower, this 4.25%, is a full percentage point lower than the growth forecast for the US in 2021, despite the fact that the decline in US output last year was much smaller than that of the euro area. Moreover, while the US and Japan are expected to regain their 2019 output levels later this year, that is to say, at some point this year, they'll be back to where they were prior to the start of the crisis. For the euro area, output is expected to remain below its 2019 level into next year. So going forward, the euro area authorities face, I think, three key challenges. One is to sustain supportive policies for longer than initially anticipated, given the arrival of these multiple waves of the virus. Secondly, fostering the post-pandemic transition to reflect a changing economic landscape. And third, to address crisis legacies, including especially, I think, the impact on inequality, both within the region, both within individual regions in the euro area and across the euro area overall. Our staff report makes several recommendations in this area. Again, I won't go through them all, but I'll just do some of the highlights. First, on fiscal policy, policy will need to remain supportive longer than expected because of these multiple waves, despite higher debt levels, and countries should avoid tightening until the recovery is fully underway. But over time, the mix of policies is going to need to evolve from providing generalized support to more targeted interventions that will encourage the movement of workers and capital towards firms and industries that are more likely to be viable in the post-pandemic world. And eventually, but inevitably, high debt countries will need to begin a gradual process of consolidation to restore the fiscal buffers that have been eroded during the crisis. Second, the next generation EU package is not only an important demonstration of European solidarity, but it could also have significant macroeconomic effects. Maximizing the impact of the Recovery and Resilience Fund will depend on the quality of the investment it finances, the degree to which those investments are additional rather than simply replace what was already planned, and third, the extent to which they catalyze rather than substitute for necessary structural reforms. I want to talk about also briefly about what the RRF is not, what the Recovery and Resilience Fund is not. The RRF is not the centralized countercyclical fiscal capacity that the fund has advocated for a long time. But successful experience with the RRF could help lay the groundwork for the eventual introduction of such a capacity. Third, monetary policy should remain accommodative for as long as necessary to achieve the ECB's medium-term inflation aim. The recalibration of monetary policy instruments at the ECB Governing Council's December meeting was welcome, but further accommodation could prove necessary depending on inflation developments, especially in a downside scenario. While we don't discount the concerns about an extended period of monetary accommodation and the risks that it might imply, we believe the benefits of monetary policy accommodation continue to outweigh those risks. Fourth, the authorities will face a delicate balancing act to ensure that going forward, banks continue to be part of the solution and do not become part of the problem. The European financial system entered this crisis in a stronger position than it did the last one, and accommodative financial policies have supported lending. Nonetheless, medium-term strategies to reduce non-performing loans and to strengthen insolvency strategies to reduce NPLs and strengthen insolvency regimes will help accelerate balance sheet repair. Closing gaps in the EU's crisis management framework, including through the recent progress on ESM treaty reform, will help complete the banking union. Advancing other financial sector architecture reforms would also be welcome. Last but certainly not least, structural policies will have to play a key role in facilitating resource reallocation, limiting scarring, and protecting the vulnerable. A combination of several policies, including adjusting job retention schemes, promoting job search, and providing carefully targeted hiring subsidies supported by product market reforms, will likely be necessary to achieve these multiple objectives. More broadly, to make sure that people are not left behind, a more fundamental rethink of how to adapt labor market policies to respond to accelerating automation and to facilitate green and digital transformations may be needed. So that's a summary of the main conclusions of the report. Again, the report itself is available on the IMF website. And with that summary, I'd welcome any questions that you might have.
Yeah, thanks very much, Phil. Well, I would certainly recommend that people do go to the website and read it. It's 77 pages. So brainy people like you can get through that in about 20 minutes. And it's very well laid out and extremely well argued. If I could just go into one or two of these points, this very meaty subject here, Phil, you make the point about inequality and you make that on several different occasions. What do you think about the differences amongst the individual countries in the European Monetary Union regarding the pace of recovery? Because it's very noticeable, isn't it, that some countries have had a better crisis than others. They've all had a pretty torrid time, but the gap in the growth contraction is quite large. Germany has got the same debt to GDP as it did in 2011, whereas the Italian debt to GDP, public sector debt, has gone up by about 50%. Are you worried about the pace of recovery in individual countries will be quite non-standard? Is that an area of concern for you?
It is. I think you're certainly correct that the crisis hit different countries to a different extent. And I think there are that reflects probably a number of factors. One is the crisis itself physically arrived in some economies more rapidly than it did others. The structure of the euro area economies differs across countries. There are some countries where tourism is a much more prominent element of the economy than others. And tourism and hospitality in general is one sector that was especially hard hit by the crisis. So I think some of the different experience reflects that. Some of it may reflect differences in their healthcare systems. I think all the countries in Europe or in the euro area, I should say, have aspects in common with their healthcare systems, but still there are different capacities of healthcare systems. And that may also have affected the extent to which the crisis struck different countries. In addition, it's important to note that countries had different amounts of fiscal space coming into the crisis, and that may also have affected their ability to respond to the crisis. But I think coming out of the crisis, we do have those concerns about the ability of countries to respond. And some of that does reflect these differences in fiscal space. The fact that there are some countries that would seem to have much more space to respond with fiscal policy to the crisis and to address some of these priorities that I laid out in discussing the recommendations of the report. There are a couple of things to be done about that. One is, as I mentioned, there's been a huge response at the central area, at the central fiscal area to the crisis. Next Generation EU is one example. The pandemic support facility that the ESM has come out with is another. There's SURE, the European Commission's response to help support unemployment insurance for affected individuals. So there are a lot of resources at the central area, and it will be important for countries whose fiscal space is more limited to make full use of those. The other point that I would make is that it's important that countries not tighten policy too quickly. There will be, I think, huge pressure, particularly on highly indebted countries, to respond to the crisis by tightening fiscal policy. We've seen a huge increase in debt levels everywhere. And there's obviously going to be pressure associated with that to bring debt levels down. But I think it's key that countries not react too early to that. They wait until there's clear evidence that the recovery is the economy is firmly on a path to recovery before they begin to tighten. The risks of tightening too.
Are you calling here for, if you like, a convoy approach, that those with the fiscal space, goes back to very much traditional arguments from the IMF in past years, those like Germany and the Netherlands and the Austrians and so on, they use their fiscal space and they go into the front line, if you like, and let those with greater indebtedness carry out some modest consolidation with those less indebted countries perhaps taking up the strain?
Well, I think clearly it would be helpful for smaller economies with less fiscal space if those with more fiscal space took on additional investment. But I think there's a strong case in those countries with more fiscal space to do it for their own benefit. I think the EU has set out important goals in terms of addressing the impact of climate change. And there's a key case for investment in that area to facilitate the response to climate change. There's a case for improving digitalization, and there's a key case for investment there as well. So obviously there would be important spillovers if countries with more fiscal space use that. But I think there's an argument in their own right. It doesn't necessarily need to be purely a case of lack of self-interest that would motivate these countries. It's not just beneficence towards their fellow euro area members. I think there's a strong internal case for increasing investment in these countries as well.
What about the side effects of over-accommodation? You carefully mentioned that there are these side effects. You take those into account. You say, nonetheless, the risks of too much accommodation are actually relatively low compared with the risks of not enough accommodation in the monetary sphere. Nonetheless, are you worried that there might be some element of pro-cyclicality creeping in to the euro area, maybe towards the end of this year. If you have the fiscal approach, which is going to be on expansion, you have the Next Generation Fund, which, if spent wisely and well, will deliver a big stimulus, and you have a lot of monetary easing. Could that not lead to a greater degree of inflation than the ECB would like?
We are certainly, as you note, aware of the risks that come, particularly on the monetary policy side, from an extensive and extended period of monetary accommodation. At the same time, we do think, as you pointed out, that the risks associated with tightening monetary policy too soon would be greater than the risks of continuing with monetary policy accommodation. We've seen some pickup in inflation if you look at the January data, but inflation remains well below the ECB's medium-term aim. And we expect coming out of the crisis that even as the economy gets back on its, even as the recovery continues and the economies get back on the path to recovery, we expect there to be a considerable output gap for some time. And so for those reasons, we think there's a strong case for continued monetary policy accommodation. Right? The ECB is an inflation targeter. Inflation is likely to remain below its medium-term aim for some time. And so there's a clear case for accommodation. There are risks that come from excessive financial accommodation. We don't see those risks and in fact, there were some imbalances arising even before the crisis, but we don't see those risks rising dramatically. And if they do, there are macro financial measures that can be taken and prudential measures that can be taken to try to contain those. But for the time being, we definitely see the risks of tightening monetary policy too soon, derailing the recovery, and frankly, dealing with the financial stability impacts of a derailed recovery. We see the risks for those reasons, we see the risks of monetary tightening exceeding the risks that would be associated with continued accommodation right now.
Do you think the spirit of 2008 and 2011, when the ECB definitely did tighten money at the wrong time, that was under a different regime, of course, when Jürgen Stark was playing a big role on the council. Do you think that spirit still somehow haunts the ECB? One remembers when Mario Draghi got in November 2011, the first thing he did was to totally reverse those interest rate increases. And of course, since then, the ECB has eased ever since.
Yeah, I don't know that I would say that it haunts, but certainly, all institutions try to learn from previous crises. At the fund, we think we've learned from previous crises and tried to apply those lessons. And again, the ECB is an inflation targeter. Inflation is below the aim and is expected to continue to be below its aim, and that calls for continued accommodation.
I wanted to bring in Mario Draghi. I know you don't want to talk too much about individual countries and personalities, but nonetheless, there is now a potentially quite a wonderful balance now coming our way. You've got Mario Draghi, age 73, same age as Adenauer was when he took over as German Chancellor in 1949, potentially helping the Italians to spend the recovery fund money much more wisely and much more well with great degree of efficiency. Could that somehow, if everything goes well, lead to a greater and a better balance between monetary and fiscal policy in the euro area? Because the ECB, by common consent, has been doing a great deal, maybe too much of the heavy lifting over the last 2 or 3 years. Could a greater degree of efficiency in using public money, particularly in Italy, pave the way for the ECB to scale back some of its purchases? Everybody would be very happy, I think, if the ECB were to have to do less and the governments were to do more.
I think clearly there's a role for fiscal policy to contribute to promoting growth, both growth of current output and potential growth. The Next Generation EU, as I mentioned, is one avenue for that. The impact of the Next Generation EU will be maximized if the money is spent wisely on investments with high multipliers. There's a role for investment in individual countries in the euro area as well. So I think there's lots of room for fiscal policy to support a recovery. And to the extent that the recovery begins more quickly, output gaps close, and we begin to see inflation pick up, that would create scope for the ECB to begin adjusting some of the extraordinary accommodation that they've provided so far.
You've mentioned the recovery fund, the Next Generation Fund, and in your report you give a lot of absolutely justify glowing praise to this, because it was quite a breakthrough in July last year. We remember that 4-day summit or 4-night summit in Brussels. Are you happy with the progress on this so far? It seems to be taking a bit of time for this thing to be getting off the ground.
Well, first of all, we certainly underscore the really path-breaking nature of the next generation EU funds. As long as countries are continue to be able to borrow at very low interest rates, the rollout of the next generation EU funds, whether it comes a few months earlier or a few months later, is not as critical as making sure that it's done correctly. And so we look forward to the implementation of next generation EU. We look forward to looking at the individual country plans and seeing what policies and what investments they plan to finance. As I mentioned, it's critical that this not be seen as a substitute for structural reform, that this needs to be a complement for structural reform as well. And so we look forward to seeing how country structural reform plans are woven into their next generation EU plans. But overall, we don't see the delays so far as being anything that would critically impair the ability of the next generation EU program to contribute significantly to output growth.
Will the IMF in some way be helping individual countries and the European Commission to monitor the way that the Next Generation Fund is spent, both in loans and grants? Because you do have quite a lot of technical expertise and quite a lot of experience. Have they asked you for your advice on this?
I'm not aware that they've asked specifically. We do a lot of technical assistance and capacity development. That tends to occur primarily in lower income countries. But nonetheless, we do things like public investment management analysis and public expenditure reviews, including in advanced economies. So that's one avenue that this could follow. Of course, as part of the Article 4 process in general, for every IMF member country, we do a deep dive on fiscal policy and on expenditure, and it could arise from that as well. You pointed out that the Euro area report is 70-something pages. That's not by IMF standards a particularly long staff report. So you can tell just from the page count that we go into a great deal of detail in analyzing countries' plans. And so it would be natural that this is something that the fund would be looking at very closely as well.
Yes, well, that's probably a good sign that it's not gone to more than 100. Then that means they're in a bit of a mess, probably. And no, so I take your point on that. One of the aspects of the Next Generation Fund, which a lot of people, I'm sure, also on the call are interested in, is the role of the euro. There will be this borrowing by the European Union, large-scale borrowing, and it will be backed up. The repayment will be backed by own resources. Some people have called this a Hamiltonian moment. We all know Hamiltonian moment was slightly different. I don't know whether you want to go into the question whether you think this is now a permanent facility that will give the European Union, therefore, permanent own resources and would, therefore, bring it closer to the long sought after fiscal union. Would you like to take a stab on that one, Phil?
Sure. A lot depends on what happens with the Next Generation EU, on how successful it's seen as being, on whether or not the investments that it finances are seen as being productive, on whether or not it does help promote structural reform as well. This is not, as I mentioned, and as you mentioned as well, the counter-cyclical fiscal instrument that we have long advocated for the euro area. We think some sort of centralized fiscal capacity would be extremely useful as a stabilization tool, and this is not that. But this does, the Next Generation EU, if it's implemented successfully, if it's seen as helping contribute in a meaningful way, could lay the groundwork for the eventual adoption of that countercyclical fiscal instrument. So we're not there yet by any means, but we can certainly see how a successful rollout of the Next Generation EU would be a step on that path, and conversely, how a failure to capitalize on the Next Generation EU could set back the hope for progress in centralized fiscal capacity. So it will be important that this be done carefully.
Good. So it could be very much a step in the right direction, but we're not there straight away. I'm going to open up the questioning to the audience in just 1 minute or so, starting off with Danai Kirikopoulos and Katerina Nice. So please get ready to ask your questions, the two of you. But just before we get on to that, another feature of the Next Generation fund is that this could possibly be giving a bit more of a stimulus to the euro as a proper international reserve currency, because it's number two to the dollar, but quite a long way behind. Some people think that the very fact that the EU will be borrowing big time in euro, this could enter into a lot of sovereign reserve holdings. What do you think about that? Is this at all important, whether the euro becomes something more of a rival to the dollar as the international currency par excellence?
The euro has very, very slowly increased its role as a reserve currency. When the euro was first officially issued in 1999, something like 3/4 of global reserves were held in dollars, and I think 18% was the number for the euro. As of the third quarter of last year, it was 60% dollars and about 20% in the euro. So there's been a very small increase in the role of the euro as a reserve currency. I think this reflects a number of factors. One, as you mentioned, is the lack of a safe asset, a euro-denominated safe asset. And with the creation of the Next Generation EU and the Recovery and Resilience Fund, the ability of the Commission to borrow in its own name, this will help address some of that. In fact, there'll be, I think, a significant increase in the stock of euro-denominated assets just because of that, particularly when you keep in mind that a lot of the debt that's been issued by AAA-rated sovereigns has been bought by the ECB. So the Next Generation EU could actually lead to a significant increase in what's available to borrow. And if you look at the financing of European supranationals like the European Investment Bank and the ESM, probably about half of the demand for these new Next Generation EU assets will come from outside Europe. So that'll be a step in the right direction. In addition, the traditional channel of reserve accumulation through trade, with the EU's continued commitment to strong multilateral engagements, should help as well. If the Next Generation EU leads to greater competitiveness of European firms, that should help as well. So I think there are a combination of reasons to think that the reserve role of the euro will continue to rise over time. But I think we also need to recognize that the dollar is going to maintain its dominant role for some time, that the euro's role as a reserve currency can continue to rise, but it's a long way behind the dollar and will probably be so for some time.
Good. Well, let's have the first question from the audience. Danai Kurikopoulou, our chief economist, would you like to put your question, please, about the pressure on the highly indebted countries?
Thanks, David, and thanks, Phil. Very interesting discussion. Yes, you mentioned earlier that one of your worries is that countries with high debt levels in Europe will be pressure to tighten too early, and that you recommend that they should wait for evidence that the recovery is back on track before they start doing so. I was wondering if you could add a bit more color to that. What would you consider as sufficient evidence that they can start tightening? And also, when do you forecast that this will be based on your estimates?
Thank you very much for the question. That, in fact, is a difficult question to answer. One possibility is to turn to output gaps and say when output gaps are closed. I think I'll go back to what I said at the beginning, that there's a huge amount of uncertainty, and that uncertainty applies to output gaps as well. Output gaps are always a murky concept to begin with, and particularly given the structural shifts that are happening in economies, in part as a result of the pandemic, they may be even murkier than usual. It's clear there's been a hit to demand, but there's also been a hit to supply. And how those two shake out is difficult to say. So thinking about output gaps may be illustrative, but I don't think they're going to be definitive by any means. I think it's difficult to point to a single indicator, but I think countries will have a sense of when the recovery seems to be on track, based on what's happening with employment, based on what's happening with bankruptcies, based on what's happening with investment. The other point that I should make is that some of what appears to be tightening, we may see tightening that appears to be structural in the sense that it is not being driven by the cyclical recovery per se, but that is really better thought of as being cyclical. I'm talking here, for example, about expenditure on healthcare. Healthcare expenditure has obviously gone up dramatically. That's not something we normally control for in cyclical adjustments of the fiscal balance, but we obviously would expect spending on healthcare to decline as the vaccine becomes more widely distributed, as treatments for the virus become developed that result in lower hospitalizations. So we're going to see a lot of what looks to be structural tightening of the fiscal balance that really is better thought of as being cyclical. And so we may see what looks like it's going to be tightening going forward in this year in particular that is really better thought of as being cyclical. So I think, in answer to your specific question about how will we know, I think countries will know when they see it, but it's difficult to come up with a single indicator that will say we now know we're on the path. And I think that again calls for caution and avoiding the tendency or the risk to tighten too early. If you tighten a year too late, I think that's certainly better than tightening a year too early.
Thank you. Catherine Nice from PIGIM, you've got a question also about fiscal policy, which plays very nicely into what we've just been hearing.
Great, thanks. Really interesting discussion. I'd just be interested in your views around this review, the European-wide review of the fiscal framework. I think one thing we've also got in Europe now is this sort of independent fiscal board. And does the IMF have any thoughts or views as to how they'd like to see some of these fiscal reviews reformed, in the coming years?
Yes, we last did a study of European fiscal rules a couple of years ago, and there's a selected issues paper, or a staff discussion note that was produced that talked about what we were looking for. What we called for in the case of Europe was a expenditure rule anchored by a debt target. So the idea is that you would have a debt objective. You would then trace out an expenditure path that works you towards that debt objective over time. The advantage of an expenditure rule is a lot of the questions related to how big is the output gap go away. In a sense, if you fix expenditure, you then let revenues fluctuate with the economic cycle. Over the long term, you're fine because these things wash out. But it avoids the need to constantly be targeting the output gap and trying to calculate the appropriate balance based on that. So we think there's a lot to be said for that. Given everything that's changed, we're going to take another look at that in the context of the review that Europe is undertaking now of its fiscal rules. We'll be taking a fresh look at our recommendations and about what's called for. But that recommendation that we have to get away from reliance on the output gap and to adopt a rule that's clearer and easier to explain and communicate. Something like a medium-term debt objective as an anchor with an expenditure rule leading towards that has been what we've recommended in the past.
Just before we go on to the next question there, Phil, would you be considering doing this in public, this review with the European Fiscal Board? Because I think there's a huge amount of interest in that, maybe more so than there is in the massively talked about monetary review that the ECB is doing. So I think having some public hearings on this and bringing in some of the economists and some of the ordinary people around the EU in that fiscal review would be a remarkably positive thing to do.
Well, we certainly hope to contribute in a useful way to the debate on fiscal rules. This is a topic we'll be studying for our next Article 4, and it's something that we'll be engaging in technical discussions with our counterparts. We have a lot of expertise in the fund on fiscal rules. I noticed that my former colleague at the fund, Teresa Terminacian, is on the call, the former head of the Fiscal Affairs Department, and she, of course, knows better than anyone that this is a huge area of expertise for the fund, and we do plan to leverage that expertise in a way that we hope contributes to the debate and to an informed decision.
Good. Well, that's very good. That's our old friend, of course, Niels Tugerson on our advisory council, who's heading up that board. Can I bring in now Vinit Sharma from Accenture? You've got a question quite controversial about debt cancellation. Vinit, can you hear me? Over to you.
Yeah. Sure. I have a question regarding, about the fiscal stimulus and excessive monetary risk, attached with it. For example, it can create, these zombie firms also, and the bank profits are also quite low at this point of time because of low rates. So can it be a solvency capitalization issue for banks, regarding it? And my second question is regarding the debt cancellation. Do you feel that, that some of the nations, are going to be, which are not going to be able to have that sort of growth, will be able to have that sort of, leverage, so that they can have that some kind of debt cancellation, so that they can be able to, sustain themselves for such a certain period of time, because ultimately, we are going to see in this type of crisis like COVID, that there will be some type of Greece type scenarios, that will be there,
Good.
Greece or
Okay.
Italy
Well,
or
let's hear what you have to say about those 2 points, then, please, Phil.
okay. Yeah. Okay. Yeah. Sure.
Thank you.
Okay. On on the impact of low interest rates, the European banking system has suffered from low profitability for some time, and that's an issue that has needed to be addressed and needs to continue to be addressed. At the same time, the studies that we have done of the capitalization of the banking systems, the stress testing that we have done, suggest that banks are well capitalized, that they're in a position, even in a downside scenario, to withstand those shocks. And so we don't see even a downside scenario as leading to any sort of crisis in the financial system. But there are issues, longstanding issues related to profitability that will need to be addressed. We have not seen the big increase in NPLs yet that I think most people expect is coming, and that reflects some of the accommodation that's been given to firms since the outset of the crisis. But as that support is withdrawn, we would expect to see an increase in NPLs, and it will be important for banks to develop to improve their capacity to deal with those NPLs. And that requires in part there's a role for supervisors to make sure that banks have adequate plans for NPL resolution. There's a role for strengthening bankruptcy procedures to make sure that there's an efficient, those can be disposed of efficiently and reducing the losses associated with them. There may be a room at individual national levels for some sort of asset management company that could take over impaired assets from banks. So there's lots that can be done to deal with the rise in NPLs that's coming, but we don't see banks, and there's lots that needs to be done to increase profitability, but we don't see, even under a downside scenario, there being a threat to the capital position of the European banking system. On debt cancellation, I'm not going to get into a discussion about individual countries and the possibility of debt cancellation. We don't see that as being in the cards. There's been some discussion about whether or not the European Central Bank might cancel some of its debt holdings. Is there a case for the ECB to cancel the debt that it holds from sovereigns, given that the stock of those holdings is very large? And there are a couple of points I could make on that. First of all, it seems to run counter to the ECB charter, so legally it does not seem to be an option. Even economically, I'm not sure it would make that much of a difference. The fact is interest rates are very low. Despite the big increase in debt, financing among sovereigns, financing costs have not gone up because rates are so low. Moreover, what's collected by national central banks, who are the actual holders under the ECB system of this debt, the interest that they collect on this debt is funneled back in dividend payments to the national governments anyway. So if you cancel the debt and cancel the interest payments on them, it winds up affecting the budget anyway, because all that money cycles back. And it does run the risk of decapitalizing the national central banks. And there are lots of stories of central banks that have operated with negative capital for some time, but they're usually not happy stories. So I think, there are legal things that prevent the ECB or the European Central Banking System, I should say, from canceling its sovereign debt holdings. But I'm not even sure the economic impact would be all that significant if they could. And what economic impact there is could be attained just as easily by those central banks continuing to roll over their holdings of sovereign debt as they mature. So you do see discussions sometimes about debt cancellation at a central bank level, but I'm not sure it's legal, and I'm not sure it would do anything.
Well, thank you. I think there's been
and certainly it would do something that could be more easily done just by rolling over the debt.
There's been a petition, I think, over the weekend, hasn't there, by some economists, including Thomas Piketty. Not many German economists in that group, I have to say, calling for the ECB to cancel its debts. But I think you've given it quite a strong rejoinder here, Phil. Just before I bring in your old friend Mark Sobel, who's got a question about the ECB, can I just ask you, in all your forecasts and also what you said right at the beginning when you started expounding your most recent reports, you were saying that the Europeans are still going to be, well, they're going to be even further behind the United States in terms of the recovery than they were before the pandemic struck. There's also going to be a big growth gap opening up, even bigger than there was before with Asia. Have you thought through what this means for the geopolitics of Europe? The fact that we're going to have another 5 or 6 years, it seems, with substandard European growth on top of the last 10 years of substandard European growth. What does that mean for the overall political cohesion of the continent?
I mentioned that that we have concerns about high debt countries being forced to consolidate sooner than they should. Even if they consolidate, even if they avoid the temptation to tighten too early, some tightening on their part will be necessary and inevitable over the medium term, given the increase in debt ratios. There are concerns that the convergence that we had seen in Europe has stalled, and in particular that some of the high debt and lower income countries, because of the structure of their economies, may find it more difficult going forward. And I think those are all concerns, and I think they underscore the importance of making the best possible use of the central fiscal resources like the Next Generation EU. And they really underscore the structural reform measures that we at the fund, along with many others, have been pushing for quite some time. Progress on structural reform commitments has lagged in Europe, and making better progress in addressing those structural reforms is one of the things that can be done to speed up potential growth in some of the more slowly growing and more vulnerable countries.
So let's now have Mark with a bittersweet question about the European Central Bank.
Well, thank you for doing this, Phil. Good to see you. Well, Europe's missed its inflation target for a long time. It seems that deflationary pressures are entrenched. We hear a lot of concerns out of Europe. Philip Lane, Madame Lagarde, to a lesser extent, expressing concerns about the possibility of euro appreciation. So even if fiscal and structural action is more important in your view, does the ECB need to be more accommodative? If so, through rate action or QE, or is further monetary policy action just pushing on a string? And then what do you think the ECB monetary review needs to achieve? Thank you.
Hi, Mark. It's nice to hear from you again. It is true that inflation in the euro area has been below the ECB's medium-term aim of close to but below 2% for some time, and the pandemic has accentuated that. It's led to significant disinflationary pressures. We do expect headline and core inflation to recover eventually. We've seen a pickup in inflation in January, which reflects in part the expiration of the German VAT cut reversal. So we do expect some pickup over time. That said, inflation is likely to remain well below the medium-term aim for a prolonged period because of persistent weak demand and slack in labor markets. And that suggests that sustained monetary policy accommodation is going to be needed to support the recovery and to counter these disinflationary pressures. The ECB is committed to continue to adjust its policies going forward as it needs to meet the inflation aim. We saw that at their December meeting when they recalibrated a number of the policies. On the interest rates, we think there is scope for further cuts. We don't think that that the ECB is totally out of room on the interest rate. At the same time, I think we need to be realistic. Rates are already quite low. As risk aversion rises, I mentioned earlier that we're expecting to see a pickup in NPLs. There's a risk that the impact of concern by banks about rising NPLs may outweigh the impact, any additional stimulus that comes from further cuts. So we do think that there's room to cut rates a little bit further, but I think we need to be honest and recognize that room is limited. At the same time, asset purchases have played an important role. There's the regular asset purchase program. There's the PEP, the Pandemic Emergency Purchase Program, which we think has been very effective. It allows a wider range of assets to be purchased, and so we think expanding asset purchases are probably realistically more the way to go going forward. What can they do that's new? If the bank lending channel becomes impaired, if we find that banks are not able to provide firms with the support that they need, the ECB could consider direct support to the non-financial corporate sector. The ECB could fully or partially finance a special purpose vehicle that delivers bridge financing to viable firms that face COVID-related liquidity shortages, or they can purchase loans directly from eligible financial institutions. So if the bank lending channel were to become impaired, that's one path that they could take. I mentioned that the PEP has expanded the range of assets that are available, but they could further expand the range of those assets if they needed to. They can include high yield corporate bonds, so-called fallen angels, or equity exchange traded funds. So those are additional things that could be done to provide greater support to the non-financial sector and to deal with potential stresses in different market segments. So I think there's still scope for monetary policy accommodation. As I said, not so much on the interest side, but on the asset purchase side. And there are new paths that could be taken and expansions of existing paths.
Yes, well, a very bold statement there that they might be considering, or you think they should be considering buying ETFs, but of course the Japanese have been doing that. So you could indeed say, why not the ECB? Could I ask Arnab Das now, you've got a question also on the monetary targeting and also the linkage with the United States' own targeting for the average inflation rate. Arnab, do you want to put your question?
Yeah, sure. Thanks very much, David, and thanks for the discussion. So I wanted to ask, the Fed has sort of reworked monetary policy under this new idea of flexible average inflation targeting. It's a bit like price level targeting, I suppose. And bygones are no longer bygones, right? So if there are inflation overshoots or undershoots, it may act in the opposite direction when inflation moves away from target. And it would seem on the face of it that single mandate inflation targeting central banks would have a harder time, sort of keeping up with the Fed, particularly if the Fed keeps policy looser for longer than otherwise. So I wondered what you thought of that. What can the ECB do about that if this does represent a bit of a stronger euro, weaker dollar, deflationary growth negative impulse for the Eurozone? Thanks.
Sure. Maybe I'll talk a little bit about the strategic review of the ECB in general and touch on some of those issues. That strategy review, as you know, is ongoing, and the results will be published in the second half of the year. But we do, in the Article 4 report that just came out, look at some of the issues. And we find that, first of all, that a symmetric point target, saying, the target is, to pick a number, 2%, and we are symmetric around that, outperforms a asymmetric target like the one that the formal target of close to but below. So we think a symmetric target would be better. In fairness, the ECB has been emphasizing that in practice they've been using a symmetric target all recently, but we think making that explicit would be helpful. And we think having a specific number around which that target is approached symmetrically would be useful rather than the close to but below. So we think in the case of the ECB, having an explicitly symmetric point target would be useful. We also think that it's likely that the ECB, as part of this review, is going to give some thought to embedding climate change considerations, at least in its operational framework. which some central banks in Europe, like the Riksbank and the Swiss National Bank, have already done. In terms of inflation, average inflation targeting, I think it's something worth exploring. There are concerns that it could potentially lead to greater output volatility than a more standard approach. I also think we need to recognize that in an environment like in Europe, where inflation has undershot the target for an extended period of time, moving to a symmetric target is not likely to be, even if that were what the ECB chose to, moving to average inflation targeting, even if that's what the ECB were to choose to do, would not have huge immediate payoff. Discussions about how you will behave, how long you will allow inflation to remain above the target when you have not been above the target in quite some time, obviously are not as consequential as they might otherwise be. And so we think that that's something that the ECB might want to consider. There are, as I said, some questions about whether it leads to greater volatility. But this would be, as a practical matter, more of an evolution than a revolution, given where we are with inflation and have been for some time.
And on the issue about the dollar, is there an issue that the fact that the Federal Reserve is actually throwing the kitchen sink at getting inflation up and seems to be maybe more expansionary than the ECB, is that not a recipe for a weaker dollar, and that will actually countermand the ECB's own inflation targeting?
Clearly for an open economy like the euro area, the exchange rate has an impact on the inflation level, and it's something that the ECB will need to take into account as it sets monetary policy, and when it does its forecasting of inflation rates, this is something that it looks at.
I've got a question in a moment from your other old friend, Teresa Ter-Minassian, but just before we get onto that, I just wanted to ask you about the German policy in the last few years. The IMF has been quite critical of German policy in, say, the time when Mr. Schäuble was the finance minister. You were saying that they should have used the fiscal space that they had then. Are you willing to say that you were wrong on that now? Because the Germans, of course, are now saying, well, if we'd done all the things the IMF had asked us to do, we wouldn't have the same fiscal space to use now. And they seem to be saying, je ne regrette rien. So are you saying that your policy was wrong then and the Germans were right all along?
I don't cover Germany, and so I'd rather not speak specifically on Germany. But as you pointed out, growth in Europe has lagged that elsewhere. We have seen declines in potential growth in Europe. Europe entered the crisis with a less dynamic economy. And so, there is a case for higher public investment and structural reform throughout Europe to boost productivity growth. I also want to come back just to clarify one thing on, you had mentioned the discussion that I had of the purchase of exchange traded funds. And I just wanted to clarify that's not something we're advocating now. I had premised that on what happens if there's a breakdown in the bank lending channel. And the ECB finds that the pass-through of monetary policy has been inhibited because of the breakdown in bank lending. And so that's something that the ECB could consider in the event that we see a breakdown in the bank lending channel, among many other options. But it's not something that we're advocating right now.
No, thank you. They do say, don't they, that in fact they do have all the options open and they can just go and purchase equities outright if they feel like it. They don't seem to feel like it, but you're absolutely right in saying that is a possibility. Teresa, you've got a question which has partly been answered already about the review on the fiscal side, but I think you've also got another question up your sleeve. So please do put the question now to Phil.
Yeah, well, no, on the question, first of all, Phil, nice to see you. On the question of the reform of the rules, I was wondering if you could be a little more specific about which issues or which aspects of the current system of the rules are you going to focus on most? Which one do you consider more risky or more sort of worth looking at in terms of shaping your recommendations for that? The other question is more on the model of support of that the EU or the European Union has used during this pandemic has been basically a lot of guarantees of employment, basically supporting employment as such. The question is, of course, how do you get out of this, and how do you assess the viability going forward in the post-pandemic, so to speak, era of different industries, different sectors, and within sectors, and what can be done to promote the redeployment of resources, both labor and other resources, across and within these sectors. What is the fund thinking of recommending as specific approaches in this respect? Thank you.
Okay, thanks, Tracy. It's nice to hear from you. You know, starting with your first question on the review of the fiscal framework and what we see as the key areas. We think a rule that is simple and easily communicated is better than current rules, which I think many people would agree are extremely complex and difficult to communicate. We think it's easier to build public support for a set of fiscal rules that the public can easily understand and you can easily explain to them. So I think clarity and transparency is key. But I think we want to look at the whole range of issues. There are issues about what the right debt level is and what the right fiscal balance is. Issues on which, frankly, theory is not very helpful. Theory is not very helpful in telling you what the optimal debt level is. But that's a question that needs to be looked at. Associated with that is what the optimal balance is over time. There are issues about how quickly you should return to that debt level. The existing rules now that the country should reduce their debt level each year by 1/20th of the gap between where they are and the medium-term objective would require in many cases levels of adjustment that are really too high, and so we need to look at that. We'd want to look at being sure that rules do not force pro-cyclical adjustment where it's not merited. So there are lots of issues that we want to look at, and we're coming at this with an open mind. On your second question about support for employment during the pandemic, there's an interesting open question on whether the approach that Europe took, which looked at preserving employment relationships during the pandemic, is a more effective or less effective approach than the course that was taken in the U.S., which had a much higher increase in unemployment during the crisis. This is one of the many things where the caveat that I gave at the beginning about operating under uncertainty applies. I think it's too early to know which of those was more effective. It could be, given the high, and there could be some idiosyncrasies. You know, it could be that the relatively high costs of hiring and firing in Europe mean that an approach that preserved employment relationships, like as was adopted in Europe, was particularly well suited for that environment, and maybe would have been less well suited for the U.S. So it could be that it might not be that either one is better than the other. It could be that they were both right for the particular circumstances. But there is the question of how do you make sure going forward that you don't just have stranded assets, that you also have stranded jobs, that you have people who are locked into jobs in industries that don't appear to have as strong a future post-crisis. And you ask the question of, so one way that you move them is by coming up with better training schemes so that workers get the skills they need to move from one sector to another. You also do it by having mechanisms that encourage job search. You could have mechanisms that provide a hiring subsidy for firms in these industries that you think are more favored going forward to get around some of these issues with hiring and firing costs in Europe. You do it with lots of the same structural reforms that frankly you and I have both been talking about for some time. That, of course, begs the question, as you pointed out, of figuring out which are the firms that are viable. And that will not be easy, but there are things that can be done. You can look at firms that had a strong record of performance prior to the pandemic, where it's clear that the part of the problem they have faced is specifically pandemic related. You also want to have schemes that leave those firms with some skin in the game. where some of their own resources are tied up, which will help in self-selecting firms that are productive going forward.
Well, I think that provides us with a lot of food for thought for the future. So thank you for that very comprehensive answer. We are running out of time, but we may have just one last question from Jens Thompson, who was formerly a member of the Board of Governors of the Denmark's Bank. Are you there, Jens? Do you have a question?
I have a question. I'm reading a newspaper article.
Can
you hear me?
Yes, please. Very quick, please, Jens. Very quick question.
Yeah.
Last question.
I'm reading a paper article quoting Paul Thompson, and he tells that Greece and Italy rolled back many of the reforms after the programs were finished. Is there no demand for reforms at the Mediterranean? Thank you.
Yeah, I'm not going to talk about Greece and Portugal. I will say that that many of the structural reforms that the fund has been recommending are difficult. They're difficult politically, and that's why they have tended to lag. And that's why, again, it's important that programs like Next Generation EU and the Recovery and Resilience Fund in particular build in incentives for countries to take the structural reforms that they need. They are often difficult to do. They can be costly politically because they have a big impact on specific groups, and so there's often a lot of opposition to them. But we continue to see these reforms as being critical to boosting potential growth, to enabling countries to come out of the pandemic in the strongest possible way, and to lay the foundation for the digital and green transformations that we're looking forward to.
Well, good. Well, that's an apt way of ending it. And I think it's important also that these reforms are now being ordained by the European Union themselves and not brought in by the International Monetary Fund, which wasn't really the finest hour of the IMF, I think, 10 years ago. And this needs to be done on a homegrown basis, I think. And therefore, one could easily say the European Union has somehow grown up over the last 10 years and is now taking on the strain itself. Thank you so much, Phil Gerson, for taking us through this quite complex subject matter, a mixture of monetary and fiscal and politics. It's been very kind of you, and we look forward to engaging with you more in the future, and also to looking at your recommendations, particularly on the fiscal side. It's mostly fiscal and so on, all the old cliches. Therefore, having a session between you and your colleagues in the fiscal department and Niels Tugerson at the European Fiscal Board, and your joint views on the review of the fiscal rules, I think something in the next few months could be very useful indeed. So I'd like to say a big thank you also to the audience. Sorry to have gone on a few minutes beyond the scheduled period, but it's been very worthwhile. Phil, many thanks indeed, and over to you, and enjoy the rest of the day in Washington.
Thank you very much. It's been a pleasure.
Thank you. Goodbye, everybody.